This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps us with the search engines so that more folks can also discover and engage with all things microcap stocks. We're excited to announce that we are partnering up with MicroCapClub for our full slate of investor conferences in 2025. Ian Cassel and his team at MicroCapClub have not only built and fostered the best community of microcap investors, but it's arguably one of the best investing communities, period. We couldn't be more thrilled to leverage our expertise in curating and hosting large-scale microcap conferences and teaming up with MicroCapClub to put together world-class conferences for the microcap community. First up, the Planet MicroCap Showcase Vegas in partnership with MicroCapClub will be held on April 2022 through 2025 at the Paris Hotel and Casino in Las Vegas. Registration is now live. Please visit planetmicrocapshowcase.com for more information. See you in Vegas. My guest on the show today is Whit Huguley. He is the fund manager at River Oaks Capital. I've known Whit for a few years now, first having met him at one of my conferences in Las Vegas, and I've gotten to know and really appreciate Whit's investing style. He launched his fund, River Oaks Capital, about 5 years ago now, and while he's in the middle of writing his annual letter, he graciously jumped on the pod to talk more about what he's learned from running a microcap fund thus far. And for full disclosure, we discussed a number of companies during today's podcast, and I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Whit Huguley. Whit, thank you for joining me today. How you doing, man?
Yeah, thanks so much for having me on, Bobby. It's been a long time coming. I really appreciate it.
I appreciate the call out because, yes, we were just joking offline. This has been a long time coming. I mean, you've been coming to our conferences forever. We've been, talking offline, all that kind of stuff for all this time. And it was about dang time, if I may pull out my southern accent there. But
I think it's I think we met 4 or 5 years ago at your conference. So,
that's right.
And a ton of the investors I still keep in touch with, I've met through your conference. So super happy to be on the podcast.
Heck yeah. Look, I listen, anything we can do to help so that you don't have to do screening anymore. You can just hit up your network and find good ideas. That's always nice.
Yeah. I'll take that.
Good stuff, man. All right. Well, there's a lot I wanted to talk with you about today. Obviously, your background, everything like that. You also, I'd say in the last few months, did a really great interview with Ben Claremont on Compounders podcast. So I invite everybody to go and check that one out too. We're going to be talking, a couple things might overlap, in terms of background and some of the lessons, a couple things. But for the most part, we're really going to dive deep into microcap and Whit's background, all that stuff. So with that, Whit, I want to start off with that background. How'd you go from private equity to then running your own microcap fund? What was it, 5 years?
Yeah, no problem. Yeah, I just hit the 5-year mark on January 1st of running River Oaks Capital, which is crazy. But I think it's easiest probably to start from the beginning. I grew up in New Orleans, went to college at LSU, and then worked in for a startup company for a while, for I think 4 or 5 years. And I was just fascinated in how to grow companies, what it took to grow companies. I got to watch this business grow, but I realized I wanted to learn more on the business side of things. So I went back to get my MBA at Tulane, which is here in New Orleans. This would have been about a decade ago now. And honestly, the plan was to get my MBA and then go start my own startup company, more like in the venture capital side. And it was probably a month or two into getting my MBA. I took a investment analysis course and read The Intelligent Investor and had the stereotypical inoculation that Warren Buffett talks about, where I was just totally hooked. My trajectory of what I was going to do completely changed, like on a dime. I think those 2 years I was getting my MBA, I think I read 50 investment books. I got my CFA at the same time. I was just all in on value investing, investment analysis, and everything. And I think, it was interesting because what I was learning as I was getting my MBA about the efficient market, the cap-in model, all the kind of what they teach in finance when you're getting your MBA, and what I was reading through Warren, Seth Klarman, Joel Greenblatt, all those investors was kind of the exact opposite. One was saying the market's very efficient, it's not even worth your time to look at companies, and the other was like, if you work hard enough and you find your niche, there's definitely inefficiencies in the market. So I was certainly leaning towards the inefficiency side, but then once I worked for private equity, it became very apparent that the markets are definitely inefficient in certain areas. I mean, we were working extremely hard at these private equity firms, but some of the deals we were doing were back of the envelope type napkin calculation deals. Whereas, I was taught before that you had to do a DCF model and get the perfect price and all this. And what I was really learning at private equity was the human element behind investing, that it's not just about 10Ks, spreadsheets, audited financials, ticker symbols. There is a day-to-day human element of running a business. And that's what makes inefficiencies in the most part. And the second thing I really noticed, and I'm more just picking up on it now, but most of the success we had in private equity, most of our most successful investments when we were when we were backing A+ capital allocators. But I'll kind of loop back to that in a little while. But I mean, I got really lucky in the sense that I joined a private equity firm that was pretty big, but the deal team was pretty small. So I got to do just a little bit of everything. And we would do extreme due diligence, go visit the management teams, go to conferences, talk to competitors, talk to industry experts, talk to everyone, because you're about to buy anywhere from 30% to 50% to collaborating with someone to buy the entire company. I mean, it's the same type of due diligence you would do if you bought 10% of a local restaurant. You would go meet the owner, you would go meet the customers, who runs the company, meet the competitors. You wouldn't just read the audited financials and then invest in the company. And I feel like a lot of people do that on the public side. So I was just immediately introduced to deep, rigorous due diligence and treating it as if you're buying the entire company, because in our instance you were, but even if you're only buying 1%, you're still buying you're still buying ownership in the company. But
so you saw this, so you saw microcaps and you were like, oh, this is a breeze in terms of due diligence compared to what the hell I was just doing over here.
Yeah, that's kind of where I'm going with this. And so I mean, I think Warren Buffett, as he usually does, sums up what I say in 5 minutes. He could sum up in 2 sentences, but he says shares are not mere pieces of paper. They represent part ownership of a business. So when contemplating an investment, think like a prospective owner. I think that basically just sums it up perfectly. But fast forward to January 1st, 2020, I launched River Oaks Capital. And I take that business owner long-term mindset with me. And I'm also immediately attracted at investing in microcap companies, because that's the size of the companies we were investing in anyways in private equity. So I already saw that there was an inefficiency on the private side. So I assume it must exist on the public side as well. And I've come to find out it's even more. Obviously, the first couple of months of running the fund, quite insane. COVID hit, I guess, 2 months into me running the fund. But I mean, so just right away, and this was kind of the first, I think I'm writing my annual letter right now, which will be my 5-year letter. And I thought it would just be interesting to go through the top four things that I've learned from running this fund for 5 years.
Oh, wait, I want to come to that, but I want to go back to that time, that January 2020. I mean, it's funny.
Yeah,
I had a similar crazy experience. I became a dad for the first time during that time. You started your fund. We both had little babies
yeah,
in
yeah.
January 2020. But all jokes aside, I mean, when you started the fund, obviously, I'm sure you had a few ideas that you were looking at going in, launching. I'm sure you had
Mhm.
invested. You had a little bit of capital deployed. What was your thought process when it came to capital allocation deployment? Once COVID hit, you're seeing valuations absolutely crumble, maybe even in ideas that you were like, wow, holy crap, I can get it at this price now. I mean, what did you end up starting to deploy capital a lot faster than you normally would have? Love to hear where you did from that point, because I mean,
Yeah, yeah.
yeah, it's interesting.
Yeah, so I had already started investing family and friends' money probably 9 months before I launched the fund, officially launched the fund. So I already had a portfolio of I think maybe 10 to 12 companies at the time. I was pretty fortunate when the market took a downturn. We were still like 20% cash. But it was interesting because it tested my fortitude right away, and that was probably one of the biggest questions I had about myself going into running a fund is how was I going to react when there was a severe market downturn? And for whatever reason, I can't say why, it just didn't really bother me too much. I really did look at it as a buying opportunity, a way to average down on a lot of these companies we already own. I mean, there are plenty of things that make me nervous. I don't like flying. There's plenty of things that I get very uncomfortable. And for whatever reason, when the market goes down, or in this particular instance, it did not give me. I mean, I didn't enjoy it, but it didn't give me extreme anxiety, or I didn't like seize up and wasn't able to take advantage of the opportunity. So it was actually like a blessing in disguise in that it kind of calmed down one of the fears that I had. How was I going to react when there was a market correction? And I mean, I think obviously some pushback people would say was, well, yeah, the market went way right back up 3 months later. But I mean, there was a 3 months into the fund was down 30%, or maybe even 35%. So there was a time there where it was I was very curious how I was going to react, and I think I reacted pretty favorably.
Oh, it's so easy for us to have that hindsight bias where we're just like, oh, this everything bounced back. Some people have that revisionist. I remember very concretely March 11, 2020.
Oh yeah,
We were all scared out of our freaking minds. We did not know
yeah,
what the hell was going on. So we half of us didn't even know if we were going to have a business, if business was going to be back to normal. Like there was so many different things happening. So I would question anybody that's like, oh well, no, back at that time, 3 months, but it was all fine. It's like, no, we were all pretty nervous and scared for what was next, not just for business, but also personally and health wise. So, like, yeah, that will definitely test your fortitude.
yeah, yeah. It was an immediate test. There's no doubt about it. It was
Yeah.
6 months or 2 months in. Yeah,
I think it was Ian. I think he put out a tweet. I mean, I think he puts this one out periodically, and especially he did it during that time. I remember, and I think it's very prescient. Is that look, it's easy to say you're the greatest fund manager or investor. When times are good, it's really it's when times are tough that really is the test of a good investor. Or if you're
yeah,
really in this for the right reasons, or if you truly love it, right?
yeah, yeah,
And that time will definitely test you, that's for sure. But again, you only have to wait 3 months, right? I guess we
yeah,
could use it in hindsight, right? That was only 3 months.
yeah, yeah,
All right, so real quick, again, right before we get to the lessons, launched it, had that initial, gut check in those
yeah.
first few months there. Before we get into some of the lessons learned over the last 5 years, catch us up. Was there anything else during that time that also hooked you more, that also solidified, like, all right, I think I'm doing the right thing. I'm still, all right, I passed this first like major huge test. Was there any other, part C or part D of
Yeah,
the test that
I think that
also?
actually like that plays into what the first lesson I learned of the four lessons that I'm writing about in my letter. It's that doing the same rigorous due diligence that I did at private equity, and applying that to the public microcap markets. So, right when the travel restrictions lifted, before that, I was just meeting with management teams via Zoom. Um, but I was intent on, if we're going to buy, even if it's 1% of a company, I'm going to treat this as if we're buying the entire company. So that means flying out to visit management teams, all the things I listed, going to conferences, talking to competitors, treating it as if we're buying this whole company and we're going to hold it for 30 years. So at first, I was only able to talk to microcap managers or management teams via Zoom. And then when the travel restrictions lifted, I remember my first visit, I get dressed up, I have all my notes ready. I'm there like 10 minutes early, and I walk in, and I could tell it's $100 million market cap company. I could tell they're looking at me like, "What are you even doing here?" Like, and so within 10 minutes, they tell me I'm the first investor to visit the company in person. I think in 5 to 10 years. And that's kind of when the first light bulb moment went off. It was like, okay, this is how I can really provide value to my investors, is by doing the deep due diligence of getting on the airplane and going to meet these management teams in person, because there's just very few people doing it. And I think it's the reason it's provided value, I think, to my investors and to the fund, is that two completely separate different reasons. Is A, you'll find a company that's trading at 5 times earnings. It's 50% of book value. It's just screens dirt cheap, and you're so excited to buy it. You can't believe you found this bargain, and you fly out to visit the management team. And within 5 minutes, you realize this company is totally uninvestable. It's any of the free cash flow generated by the company is going to go to the board, increasing board fees, increasing the CEO salary, buying a private jet, who knows what else. So it kind of, it gets rid of a lot of the microcap companies that you would never want to invest in the first place. Then every once in a while, you hop on a plane. I've told this story before, but this was probably 3.5, 4 years ago. You fly to Dallas, Fort Worth, and meet with Dayton Judd of FitLife. And I'm sitting down with Dayton having barbecue in Fort Worth, Texas. And within 5 minutes of talking to him, I can realize, I immediately pick up that, this guy is, better than 99.9% of the CEOs I've ever talked to. He could run a Fortune 500 company. He's just, wants to run a small company, and that's it's his choice. And that's what really makes it worth it. Getting on a plane where it probably only happens once, twice, maybe 3 times a year. Well, I'll meet someone like that.
Hey, that's
But
still a
that's what
lot.
really
It's
gets
actually still a
me.
lot.
Yeah, I'd say once is good.
Yeah, like
And
once is actually like, oh sweet, like awesome.
yeah,
Like did
but
not
that's what
expect.
really gets my energy going, is when all the meetings with the mediocre or even management teams that are uninvestable, to find Dayton. And I don't think many people had met him in person um at this time, and it was so eye opening. Gosh, this guy is head and shoulders above the rest of the competition that I've talked to.
It's funny you mentioned that. Well, first, are you still currently a shareholder in FitLife?
Oh yes, I am a
Okay.
shareholder of FitLife. Yeah.
But they're also presenting in Vegas, and I'm excited to meet him in person. I mean, I think I met him once at another event like years ago, many years ago, and so it'll be really cool to see him
Yeah,
again.
and I think talking about Dayton kind of dovetailed into the second lesson I've learned over the last 5 years of running the fund, is just the importance of a good management team, especially in microcap companies. I knew it was important. I didn't realize how important it actually was. And I wish I could find who said this quote. I either read it on Twitter, or I'm not sure where I read it. but I wish I could find it to give them credit. But someone tweeted out or quoted, the importance of a good management team is inversely proportional to the size of the company. And basically saying the smaller the company, the more important the management team. And I knew that from being in private equity. I had observed that our best investments were always with A plus capital allocators, but I didn't realize how much of the investment it really drives. I mean, how important it really is. It's way more important than I even realized. And yeah.
Yeah, no, I want to hammer on this point because
Yeah.
we've talked about capital allocation a bunch on the pod here, and I try and ask that a lot when I do like my long form interviews with management teams is how they think about capital allocation, how they think about acquisitions, all that kind of stuff. But I think one thing that gets overlooked, and even I've gotten fooled by this because you'll just some of these CEOs are quite charismatic, and you're blown away as with them as operators, great operators. You look at the balance sheet, you're like, wow, they're killing it. They're doing a great job. But then once they start going on the acquisition trail and looking at deals and start maybe making a few, they're like, oh wow, they suck. They're not good. That's
Yeah.
bad. They just keep doing bad deal after bad deal, and they might think it's a good deal and think like, you know what, I'm a great operator. I'm just I'll be able to fold this in. I bought it at a discount. It's fine. But I mean, how often do you come across that where you're like, dang, this is a great operator, but man, they suck at acquisitions.
Yeah. I mean, I think
We
I've
don't
heard
talk about a lot, but it happens.
yeah, yeah,
It is quite
yeah,
common.
it does. And I mean, the pushback I've often heard is don't meet with management teams because in order to become a CEO, you have to be very charismatic and you're very good at selling yourself. And I'll go back to the example of Dayton, because I disagree with that, or parts just works to meet every management team in person. And when I sat down with Dayton, he just knew the business inside and out. He knew the numbers, he knew everything. He laid out exactly what his acquisition plans were. He just had a perfect long term, just everything in place. But I think what was more important is he spoke to me business owner to business owner. So he was saying, here's what Fit Life does well. Here are our core competencies. Here's how we'll grow in the future, but here's what we're lacking in. We need to improve this area. We need to hire more people in this area. We need to improve our ERP system. We need to uplist onto the Nasdaq. It was not a sales pitch to me at all. It was one business owner talking to another business owner because Dayton owns, I think, 55% of FitLife. And that was really when it started clicking. It was like, because you'll talk to a lot of microcap CEOs and their sales pitches, this is the best company of all time. There's nothing wrong with it. And there's no company where there's not anything wrong with it, and especially no microcap company where there's nothing wrong with it. So I could just tell he was being candid and honest, and he's just a sensible, no nonsense guy. And I think, I'm not sure if you've read the book Good to Great by Jim Collins, but I highly recommend it. But so he characterizes levels 1 through 5 of leaders in companies, and level 5 would be the A plus capital allocator. And I think this definition just fits perfectly with what I've seen as A plus microcap CEOs. It says a leadership style that is characterized by a powerful combination of personal humility and professional will, meaning they are highly ambitious for the organization's success, but with a modest and self-effacing attitude, prioritizing the needs of the company over their own personal gain. So that's kind of where I was going at. There, like the A plus capital allocator CEOs that I've met are just honest. They're not trying to sell the company. They're saying, here's what we're doing right, here's what we're doing wrong, here's how we can improve. And it really is, it feels like one business owner talking to another business owner, not one person trying to sell their stock to another person. And that's just what I've noticed. And I think, what I've really realized is the reason why these management teams are so important is, especially in microcaps, you're really not going to find any companies with like a Coca-Cola type of moat. Um, most of the real moats, like in air quotes, if you will, in microcap companies are just niche, small markets that aren't worth the time of major players to pay attention to. You will find certain areas due to reasons or supply constraints where there are some moats in microcap companies. But I mean, so what I'm really looking for now is an A plus capital allocator, such as Dayton Judd, in an inefficient, fragmented small market. Because if you find someone like that, they just run circles around the competition because those small fragmented markets are mainly filled with C, B, C CEOs. There's no other A plus CEOs. So, I mean, you could go through the acquisition history of FitLife and just see the multiples he's acquiring these companies at, seeing the costs he's taking out after he's acquiring them. He's just, for lack of a better word, running circles around competition just because it's a small and efficient market that there's no major player playing in. So that's kind of like going back to what you asked, like the aha moment. That was the first two aha moments I've really had. And then over the last 2 years, I think the next aha moment I've had where I've developed and I would not have thought I would have been here when I first started the fund is turning into more of a suggestivist investor. And I think that goes back to your allocation question. But when I used to visit management teams that we have ownership in their companies, I was really just assessing their trustworthiness. I was assessing their ability to run the day-to-day operations. I was never coming to them with just suggestions or even asking, "Is there ways I can help out?" I was never doing that. It was more just me interviewing the management team. And now, over the last 2 years, whenever I'm visiting companies, I'm almost always coming with a suggestion to buy back shares or something of that nature. Some companies we own are already doing it. They're perfect. I don't even have to. I'm just coming to say hello and say thank you. But I can give a specific example of a bank that an investor friend of mine we went and visited a couple months ago, and we said, your shares are trading at 50% of fair value. Have you thought about buying back shares? And within a week, they announced a share buyback program. And so I've been very surprised at how receptive a lot of these management teams are, because you'll find a lot of CEOs in the microcap space that are very good at running their day-to-day operation of the company. But once cash starts to build up on the balance sheet, they're not always the most attuned at the best way to return that. And I think, what I've realized is that just because microcap markets are inefficient now, I think everyone will agree the multiples on a lot of these companies are quite low. It doesn't mean that they can't become more inefficient. It doesn't mean that just one day we're going to wake up and the multiple is going to go from trading at 8 times earnings to 15 times earnings. So what I'm really trying to do is ensure that River Oaks Capital can make a 10 to 15% return from each company that we own without the market cap moving at all. So just via shareholder yield, so dividend and share buybacks. So, I've seen a lot of people get angry that the microcap markets are inefficient right now, but I think it's really a net positive for long-term minded investors. And, I don't think people or enough companies are taking advantage of this situation where if you're trading at 50% of fair value and you buy back shares, you can basically turn $1 into $2 right away by buying back shares. I don't think there's any other market I can think of, at least in the US, where that much of a layup capital allocation decision is sitting there right in front of you. And it's an incredible opportunity that a lot of companies are missing out on. And I mean, don't get me wrong, there are certainly companies where it makes more sense for them to reinvest into the company because they're making above market returns on the reinvested capital. But there's a lot of companies where if I go to them and I pitch, instead of acquiring another company at 10 times earnings, why don't you acquire a part of your own company at 5 times earnings by buying back shares? And I think that seems to at least work sometimes. And it's been energizing to see that this suggestivist role I've kind of taken on over the last 2 years has seemed to be paying back. And where I really figured out the power of this was medical facilities, which is a company I still own. They've bought back 50% of their shares or they're on pace to buy back 50% of their shares in the last 2.5 years. And so a lot of the pushback I've always heard in the microcap markets is that the volume's too low, you can't buy back shares, it's just easier to just pay a dividend and just get it over with. And I mean, the volume is low in medical facilities, and I've watched them buy back half of their company. Some of it's through tender offers, but a lot of it's just been through the open market. So if you really want to buy back shares, you can do it. And I've really changed my mind on that it is possible. So, yeah.
Absolutely. So, in quick follow-up to, the finding the comments to be more of a suggestivist. I mean, it seems like that also was born out of just getting more comfortable in establishing relationships with management, because you can't really go in and be suggestivist without having not necessarily the ear of management, but at least their respect. And that, you're a real investor, you're, asking good questions, you clearly understand the business. Did that, with all the due diligence that you do and the extra efforts you were putting in to meet with management, did that give you more confidence to be like, I feel like I maybe could make a suggestion here, or, give them some feedback that,
I think, I definitely think so. I think, just getting on a plane and showing that you're committed enough to travel to go and visit them. But then once they see that I'm showing, I try to visit each management team in person at least once a year and then have a Zoom call with them at least once a quarter. So there's some companies, their management teams that I've been talking to for 5 years now. So, I mean, they know that I'm not trying to get into the company, create some suggestivist campaign.
You're not trying to get on the board. You're not trying to get on the board or anything. Like,
I'm not, for instance, the bank that I push for them to buy back shares, I wasn't saying you should loan to this company or anything. I'm not messing with their operations in any ways. It's just kind of subtle suggestions that I think oftentimes are appreciated. It's like, we haven't even thought about it that way. And we could use some push from outside shareholders. And, another thing I'll do is when I am going to visit these companies, I'll reach out to other large shareholders as well, and just say, FYI, I'm going to pitch to this company to buy back shares. If you wouldn't mind emailing them as well, to think about it, just to kind of have a collaborative of people. But yeah, I do think developing relationship is a huge part of it, especially when no one else is going to visit them. When I'm the only person visiting them or one of few, it certainly has helped.
Absolutely. So, Whit, I mean, when you've been going down the suggestivist journey, and let's just make it so that, like, okay, the capital allocation choices, buy back shares or do acquisitions. At which point have you ever had let's say, an experience thus far in, being more open with management as to what you think might be value accretive, and be like, all right, maybe the acquisition looks a little expensive, where maybe you could just do a share buyback, but maybe you should look at this acquisition. Like, when has there been a time when you've been like, I'm not sure if the buyback is the right call versus, maybe they should do that acquisition that on paper might look a little expensive, but it might make sense too.
Yeah, I'm trying to think of any specific examples, but it feels like most of the companies where I'm reaching out for them to buy back shares, have stagnated in growth, and they don't have any M&A opportunities, and that's why they're priced oftentimes at 50 cents on the dollar. Like Innovative Food Holdings, which I own shares in that I'll get into later, and companies like that, I think it makes sense for them to keep acquiring companies because they're making above market returns. Same with FitLife and some of the other companies. I think their M&A strategy makes perfect sense. So if I see a company that is making an M&A acquisition that doesn't make sense, it's overpriced, I would probably be more inclined to just sell and just move on than try to really fight that battle. I want to back a capital allocator that has the common sense when it's appropriate to make an acquisition and when it's appropriate to buy back shares. I mean, part of the journey is everyone's going to make a bad acquisition here or there, but as long as their batting average is reasonable in acquisitions, that's kind of how I think about it.
Very cool. So oh, sorry.
I was going to say I could just go into the fourth and final point that I've learned. The hard way, I guess, over the last 5 years. It's reiterating what a lot of value investors, I'm sure, learn is just having an adequate margin of safety whenever you're buying a company. So, anytime you're investing, there's going to be unpleasant surprises. But in microcaps especially, there is a plethora of unpleasant surprises. And, the two examples that pop in my mind right away over the last 5 years are BB's, which we no longer own shares in, and Galaxy Gaming, which I no longer own shares in. Both of them had very left-hand turn, unpleasant surprises for what I would thought was going to happen. And we ended up on BB's actually making a decent return. And BB's ended up selling part of their business for 50% of what I thought it was worth, and we ended up making a decent return. And Galaxy Gaming, we ended up getting our money back. And I think in both of those, it was near worst case scenario that happened. And I think what's the hard part in microcap companies is oftentimes, in order to get an adequate margin of safety, you have to average down. You have to buy when the company is going down. And I think, the microcap market is the one area of the public markets that I know of that you can have a company that goes down 30% and it's completely unrelated to the underlying business of what's happening. So, for instance, Galaxy Gaming, which we no longer own shares in, went down 30% one day. And I think someone got a divorce and decided to sell their shares immediately. And so that gave us an opportunity to increase our margin of safety. And but the trick, or not the trick, but the real important part is you have to deeply understand the company, because if it goes down, your immediate reaction is, what do I know that someone else doesn't know? But if you're able to hop on the phone, call the CEO, if they're able to call other investors, just talk to everyone. And if you've done the work, you understand a microcap business, 99% of the investors. So then when it goes down by that much, it just gives you an opportunity to increase your margin of safety. And that happened both in BB's and Galaxy Gaming. If we had not bought in shares as it had gone down, and a few times it went down for reasons completely unrelated to the underlying business, we would have lost a decent amount of money, but we were able to average down on unrelated news and get that margin of safety. But having a margin of safety is, extremely important. And I have really learned that over the last 5 years.
And I think this is probably the thing that happens more often than not. I follow way too many names, and sometimes you're just, you just want to, you sometimes don't know, but then when you find it, you're like, oh no, that's not a good reason. Some of them, and on the other side too of it, right? Where it'll go up 30,
Yep.
40% in your day in a day, and you're like, oh no, what did they do? And it's might be
Yeah.
on no news, and you're like, oh no, what did they do? And they could have spent some money doing some kind of promotion. You're like, all right, okay, good to know. Bye. And yeah, it can. Yeah.
Yeah.
It's like on
Yeah.
both. It's really on both sides. The main point is that is when you understand the business truly inside and out, and even if you don't have a relationship with management or not, at least if you understand the business inside and out, you can at least understand, those wild moves throughout that day, and
Yeah, yeah. I had it happen literally yesterday. A company I own went down 20%, and I was just scrambling trying to figure out, and it was on completely unrelated news. There was just a major seller,
Mm,
and yeah, it's something that if used properly, you could take advantage of to just create more of a margin of safety. And it's other in mid cap and large cap. I mean, I guess it happens in deep recession sometimes, but it's very rarely is there just some opportunity to buy at 30% below the price that it was yesterday for unrelated news.
for sure, especially when it's very thinly traded and already, relatively illiquid. You
Yep.
see like, wow, it's down 20% on 2,000 shares. Awesome. Like, like that you don't see anywhere else but in microcap. Um, so I mean, for you, what would you say is like the overall lesson, after, like you said, you've been doing this 5 years, kind of hit on the main four things that, you took from all these experiences thus far. And I'm sure there's probably next time we talk, hopefully it won't be in another 5 years, I'm sure there'll be another four lessons. But what would you say has been your overall takeaway based on your first 5 years running your own fund here?
Yeah, I think I mean I kind of have an oversimplified formula that I created for my 5 year letter that I'm going to send out in a couple weeks here, but it's what I'm looking for is, and I kind of already said it already, but an A plus capital allocator in an inefficient, fragmented niche market with a valuation that provides a margin of safety. And I'm not going to lie, there's very, very few of those in micro cap companies, but there's enough to create a portfolio of 10 to 15 companies. And I think the second part I've learned, and we can go into it in the two most I've bought ownership in, is very much more attracted to what I call wonderful businesses. The two most recent companies I bought meaningful ownership in, I don't think I would have bought them 5 years ago because they're trading at 10 or 11 times earnings. I wanted to buy everything at a 5 times PE ratio, and I now understand sometimes it's worth paying up. And you still have a margin of safety at 10 times earnings if it's the right CEO and inefficient market combination.
Absolutely. I, so, I mean, I know you've kind of touched on a couple of examples. I mean, I think what's also nice about this model that you have is that it allows yourself to have a pretty decent sized watch list too,
Yeah.
right? Like, I bet your
Mhm.
watch list is probably even bigger than it was 5 years ago because you're like, all right, I have these main things that I'm looking for. This, I might have 10 companies that fall in the bucket of like they fit 3 out of 4. Or I'm just getting to know management team now, and they haven't done anything in capital allocation that I can like really point to yet as something that I can grade or judge, right?
Yeah.
I wonder if that let's hit on that actually, because I'm sure there's a few of them that you're like, man, these are well-run businesses, but the CEO's been just growing the business organically, hasn't really done anything on the capital allocation side that I can point to as like either a net positive and or even a net negative. So I'm not sure if I really want to fully invest in this one yet. I mean, have you come across a few of those?
Yeah. Yeah, for sure. And I think now more than ever, I'm very patient with when I buy. I take a while to get to know the company. I used to, because I think like 6 months into running the fund, there was this company I was doing a lot of work on, and right before I bought shares, it went up 50%. So, I mean, the lesson I I didn't take away this lesson, but I was thinking, oh, maybe I should have bought it faster, But now I really take my time, and I think, the company that I've most recently bought shares in, Innovative Food Holdings, was on my watch list for a while, and so was the other company I've recently bought shares in, Truxton Bank. And I was just sitting back watching from afar, and then there was a few certain things that I got to understand that tipped me over the edge, and really made me say, okay, oh, these companies are worth investing in.
Absolutely. So, another thing I wanted to talk about with you here today that, we're recording this Thursday, January 16, 2025. We're still in the new year. I can still say Happy New Year, and no one's gonna, be like, dude, it's week 2. It still works, it still plays.
Yeah.
So love to get your thoughts on some of the themes that you're seeing either thus far in 2025, maybe you expect to see, that you expect to continue seeing moving forward here.
Yeah, I mean, one thing, very interesting thing I've been seeing just from traveling around a lot and visiting a lot of companies is on the community banking side, especially a lot of M&A activity, I think is going to pick up in 2025. So what you're seeing a lot of, I mean, basically in order for it to work, a community bank needs to get to around $1 billion of assets, just because of the fixed costs that come along with running a community bank, especially if it's public. And there is a lot of community banks that are below that $1 billion mark. So what you're seeing is there's a lot of community banks that are publicly traded, that are trading at about 50% of book value, which is probably correct because they're only making about a 6% return on equity. So, but to an acquirer, they're worth at least book value, probably 1.2 times book value. And there hasn't been much acquisition activity there, but there's been some. But I think once it starts picking up, all the other community banks are going to realize, oh, there's only X amount of small, solid community banks out there that we can acquire in order to get to that scale that we need to get to. So it's going to be like either you participate in this M&A activity over the next 2 to 3 years, or you're going to miss out completely. And there's going to be no more inorganic growth left because most of these community banks have already tapped out on the organic growth. They can maybe grow 5%, at best 10% a year. But in order to get to that $1 billion plus threshold, they're going to have to acquire other banks to get more deposits. So I've already heard that investment banks are out, whining and dining community banks. You're already seeing some credit unions acquiring community banks, but I could see a lot of activity there. And I think there's just going to be more activity in general in the merger and acquisition side. I think some of that activity will probably be taking microcap companies private. I think that makes a lot of sense in this. You immediately take out the cost of being a public company, which could be over $1 million, and if it's a $50 million market cap company, that's a significant amount of free cash flow you can just take out on day one. And then if it's backed by a solid private equity firm, you could get much better lending rates if you want to put debt on it as well. So I think it has to get to a point where, and this isn't part of my thesis of buying any company, but it has to get to a point where the multiples get so low in private equity, or sorry, in microcaps, that private equity starts to pay attention. And you're already seeing it pick up a lot in Canada, mergers and acquisitions, and it's only a matter of time until it happens here, in my opinion. But I'm not banking on it happening, but it seems like it a high probability.
It's funny. I talk with Matthew Martin all the time. We just did
Yeah,
something in the
I know him well. He's great.
Yeah, literally on the front cover of this issue of the magazine was M&A microcaps, and right now we've been mostly using Canada as the case study because that's where it's been. I mean, I've been doing this now 13, 14 years. never really seen anything like that, in terms of the frequency, the speed in which they're
Yeah,
getting done, or just the openness of management, I think, as well, of just being like, sure. In many
yeah,
respects, I mean, there's obviously a lot more that goes into just an answer of sure. We're open to being acquired, but
yeah. When I visit every microcap management team, one of the questions I always ask is, has it been a net positive being a public company? And there's very few companies that say yes. It's just they're like, we can't really use our shares for currency because they're undervalued. So I mean, we could buy back shares, but it seems like a lot of companies I talk to would very much lend the ear to someone who is trying to take them private.
right. But at the same time, it's got to be the right price
Yep.
too, and you have a lot of shareholders that, I mean, it's interesting in Canada because, like, despite the premium, there being premiums on multiple purchases, like, we've all seen those 2 to 3 year charts. It's like those companies are trading at,
Right.
60, 70%, down from their highs, just a short 1, 2 years ago. And they had been, seemingly growing, or they hit some kind of snag,
Yeah.
or just been forgotten about, right? And so, it's definitely, it's not like it's. I mean, for some, it's been, they probably saw some wins, and their cost bases were low enough where they did make money, but at the same time, it's not like people have been, stoked it by any means. It's not like, I'm trying to think of like the biggest takeout on a company that, had. I mean, let's think about acquirers, right? Like,
Yeah.
think about all the outsiders or the CEOs from the outsiders in William Thorndike's book. Like, these folks made their careers not buying stuff at top of market, right?
Correct. Right.
so there's a reason usually sometimes those deals ultimately get done.
Yes. 100%.
Yeah.
And I think the last theme, I was just thinking about this when you were talking, is I think maybe I'm wrong, but I think there'll be an uptick in activists
Mm.
investing in microcap. I'm already seeing it more and more, but just people who used to be more activists around the $1 billion and above range, starting to slowly get onto the boards of smaller companies and play more of an activist role, bringing in new CEOs, uplisting onto the NASDAQ, just doing some kind of common sense things.
And you know what? At the end of the day, like, I know some people crow about, like, all right, maybe, what's gonna, where's all the good companies that are gonna go? Like, we're worried about new companies going public. Like, is M&A good? Guess what? M&A is good because it will cycle out some of those companies that probably either should have been acquired recently, or it was a
Yeah,
good acquisition. It made shareholders happy. Because I think that'll also inspire some companies that, are smaller, higher quality, to go public earlier in the life cycle, thinking, oh, hey, all right, we don't have to just stay private to wait for an exit. Not that that should be their motivation anyway, but that's definitely something that a lot of them think in the back of their head as well, of like, all right, well, if we go public earlier in our life cycle, we can continue to grow. We have the currency if we want to use it. And
yeah,
look, it's not like you just aren't available to be taken out if we decide to at one point. I think that's something that I don't know if that calculation is thought about as much. I would argue probably more in the U.S. versus Canada. Canada still has
100%.
a good deal flow and
Yeah, they
understands
do.
the importance of going public earlier. But in the
Yeah,
U.S., there's something we're trying. I don't know.
yeah. Yeah, it should be super interesting. I mean, I think the good news is I think there's regardless of what happens, there's always going to be an opportunity to build a 10 to 15 company portfolio of microcaps.
Hell yeah.
It's regardless of what happens. I mean, it takes a lot of digging, a lot of flying on planes, a lot of going to conferences, but there's always that opportunity out there. I don't think that's going away.
100%. Couldn't agree more. And plus, it's not just North America. It's a lot of globally publicly traded companies that, and a lot of these markets are extremely inefficient.
Yes.
So, all right, I don't know. That's a pretty good place to end it with. I don't know. Are we missing anything? You're going to come back on at some point. Like I said, it's not going to be 5 years until the next time again. So, anything we're missing?
I don't think so. I would love to come back on and deep dive into some companies we own
Heck
to
yeah.
kind of let you know how we think about that. But that's probably a whole nother episode in itself. So
To say the least, for sure. Well,
yeah,
with that, where can our audience go and find more information on River Oaks Capital as well as follow you on social media?
yeah. So our website is riveroaks-capital.com, or if you just Google River Oaks Capital, it should be the first thing that comes up. On Twitter, it's just my name, Whit Huguley. And I will be finishing my end of the year letter in about 2 to 3 weeks, and I will make sure to put that on all social media and Seeking Alpha and everywhere that it can be found.
So wait, was Mountain Sumac capital taken, or what you call it, palm tree
Uh,
tributary capital taken? I mean, we're
it's
running.
actually it is the street that my mom grew up on
Oh, cool. Okay,
in Baton
I
Rouge. And
apologize. I'm sorry.
no. It's a funny story because I was in private equity. I didn't realize that like oak trees and all this was like the common name for funds, and then I name it, and I realized, oh, this is the most generic name of all time. It was supposed to have this sentimental meaning, and it's just the most generic fun name of all time. But yeah, um, my grandmother raised her family on River Oaks in
Oh,
Baton
cool.
Rouge. Yeah,
That's awesome. That's a really cool story. Well, with that, thank you for joining me, man. This was a lot of fun as always. Good luck, stay safe, and if I don't talk to you beforehand, I'll see you in Vegas.
yeah, everyone should come to Vegas. It's an awesome time.
Oh yeah.